Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, while the fiscal follies continue in Washington, we're actually bumping up against the start of another earnings season, and that's what our panelists are going to weigh in on this time around with our research director, Shiraz Mian, senior equity strategist, Nick Kalivas, and ETF research director, Nina Mishra. Shiraz, what you're telling me is that this earnings season for Q3 here, it's more than just growth rates and beat ratios, right?
That's right. The growth rates, there haven't been much. Over the last 3-4 quarters, it's been averaging around 2.5%. The expectation now is for Q3 earnings growth to be a little over 1%, which is down from a little over 5% when the quarter started. But not many surprises are expected on the growth front or on the beat side in Q3. The real question is how guidance comes through for Q4, because the long-standing hope in the market has been that at some stage the earnings growth resumption will take place. It keeps getting pushed back quarter after quarter.
Right.
But right now the hopes are pinned on Q4. Our expectations are for earnings growth in Q4 to be close to 9%. So that's where the suspense is, how guidance is going to turn out to be.
All right, so in the meantime, Nick, you say one thing that kind of concerns you is financial sector, right? Given the chatter about trading profits and layoffs in the mortgage industry.
Yeah, that's really my one concern. I mean, there's been a lot of talk about weak revenues there. If I wanted to be more optimistic, the big story in my view is the fact that the purchasing managers indices were so strong. And if you look at the production and the activity indices and take a mix, they actually averaged 60 in the quarter, and that's unusually high. And you've seen pretty good profit growth, anywhere between like 10% and really almost 29% year-over-year profit growth when you get that type of reading. Now, I'm not saying it's going to be that strong this time, but I'm just saying that it's indicative of solid profit growth. So that may suggest that the non-financial sector is going to do okay. Okay,
Nina, you're actually expecting industrials and the transportation sectors to report better than expected results.
Yeah, Nick mentioned about PMIs. So global PMIs have been rising, and because of the European recovery also, I expect industrials to do very well. And transportation sector also, earnings estimates have been going up. So some of those companies may do well. Financials, I agree, they will still report earnings growth, but not as stellar as the prior quarters.
Nick, you were saying to me off the air that the markets tend to trade seasonally well in the Q3 earnings season, but ex-Washington follies, you'd be looking for the pattern to repeat itself, but now you can't really say ex-Washington because they're right in the middle of everything.
Yeah, I've been thinking about this more. I actually thought about it over the weekend. And if you look at it, what's happened is the market really does well in that seasonal pattern if there's where it goes down into it. So really what happens is the market tends to bottom out about 3 days after Alcoa reports, and then does well for about 20 trading days after. And so if Washington can be a little bit dicey here in the next 5 or 6 days and that gets out of the way, that might really be a springboard for the market to do well. But you're right, you can't kind of take Washington out of the equation, but it's one of those things where if it can settle down in a week or so, it might fit into that seasonal pattern quite well.
So Shiraz, with the shutdown still looming over the market and the October 17th default deadline quickly approaching, what do you think? With all this drama, is Washington going to steal the thunder from this earnings season?
It's possible. I mean, my hope will be that we find a resolution for both the issues this week, but the 17th is next week.
Right.
That's Thursday. And if you don't have the government reopened, then you're clubbing both the issues. And while the market didn't really care much about the shutdown issue as much, but the debt ceiling is a big deal. And if it's very acrimonious, if we are getting to the last minute and we don't see the resolution, then we may have a replay of something like what we saw in the summer of 2011, which isn't good.
Right. Let's get back to the Q3 season. Nina, does it concern you that corporations are still largely sitting on their cash?
Yeah, they have a lot of cash, about 1.48 trillion. But the problem is that most of this cash is lying overseas. Per Moody's estimates, 61% of the cash is lying overseas.
Yeah, we saw that with the Beanie Baby guy just recently.
And further, most of this cash is held by the large tech companies, with Apple accounting for almost 10% of the total, and top 5 accounting for about 25% of the total. So these companies have been spending the US cash on increasing buybacks and dividends, more buybacks than on dividends, but they are not hiring as much, and they are not spending on capital expenditure as much because of muddled through growth economy and monetary uncertainty, and now fiscal policy uncertainty too.
Yeah.
So I expect they'll be continuing to spend more on dividends and buybacks, but they will still not repatriate overseas cash because of tax consequences.
Yeah, Nick, you kind of traced that to caution that they're using because of what's going on in Washington, but they had been sitting on cash long before the Washington thing came up.
Yeah, I think people are. I think the memory of 2008 is so great, and I think there's still a lot of worries about, kind of what the financial system could do, and so, I think there's kind of that risk aversion that shows up in cash.
And there's also the possibility that, or at least one could hope from the corporate side, that there will be this grand bargain in Washington, which will give you at least a one-time reprieve on repatriating that cash. So why not wait for that? There's nothing to invest the money in anyway, given how soft the demand picture has been. So keep buying back your stock with it. If you can make acquisitions with it, good. Otherwise, keep it nicely stashed away.
Nice and comfy, cozy.
That's right. Yeah.
Okay, thank you all for that. And they're not going anywhere, because in the next segment they are going to impart their top picks of the week for you. So click on over.